Hey guys, it's Mike Satoshi with Sharing in the Disruption podcast, where I help you figure out all the disruption going on with technology in the traditional world and how it's disrupting everything, and that we can take advantage of it and make some money. So, we've got a lot of big topics to cover today, and I'm excited to be back from some vacation. So, I'll start off with like 2 weeks ago, it looked really good on the front of COVID, and the the success rate of the vaccine was really high, and it's not looking so hot right now. I have heard through just kind of word of mouth of people around me, of people getting it that have had the vaccine, and then I was listening to the All In podcast the other day. One of the hosts, David Sachs, he's on there. He actually got COVID sitting outside under a covered roof, gave it to his daughter by accident, and he got it from someone else that had been vaccinated. He had been vaccinated. And so this vaccine, or the virus, is able to get through the vaccine. He had mild symptoms, but he was talking about how it's kind of spreading in California. And I'm in North Carolina right now. I haven't heard a ton about it, but I did just pull up some statistics, and I'm preparing myself financially if, like, our market really is just starting to go back up. And I mean, obviously last year we had all that money pumped in and the market was going up. But then if you actually look at all the money that was put into the economy, it inflated because there's more money. So actually it was just keeping up. And if you had cash, you just got screwed. Your money lost a bunch of value because we had like $10 trillion pumped into the economy. So here, I don't know if you can see this. This is North Carolina, and you can see COVID cases dropping dramatically, but they are going back up. And it doesn't seem like it's a big deal if you have the vaccine. But the trouble is, we haven't really reached herd immunity, and from what these guys were discussing, they think that anybody that hasn't got the vaccine is going to get it because of the R naught, and the rate of transmission has dramatically increased. And I don't really know what's going to happen. I don't think the American public has the stomach to go through another lockdown, but it just depends what governments do. And I was talking to somebody in the food service industry the other day, and they're like, dude, businesses can't handle that happening again. Like they just can't handle it. You're going to lose like most of the businesses, like the restaurants and stuff like that, because you're working on razor thin margins anyway. And we can't just have an economy of like Zooms and I mean, you're just going to see more wealth disparity. And the people that get screwed, last year all the office people were fine. They were complaining because like they were at home all the time. But honestly, like I was working out in the field last year. I still got to go to work, but it wasn't fun. I had to wear a mask, going to people's house all the time. This year, I work in agriculture and I'm in a greenhouse. Only work with like 3 or 4 people, so it's not the end of the world for me. But if I had been in like an industry, like certain industries shutting down, like that's going to just kill the economy. And we can't have people just sitting at home again, just collecting checks. Like we can't have an economy based off that. So I personally have been buying 2 types of stocks lately. One is more recovery stocks. Not recovery stocks, stay-at-home stocks. I bought some Zoom and a couple other stocks that have to do with like pretty much being in a lockdown again, because I think some of those like heavy, like obviously like your Microsofts and all these, they've gone record highs again, but stuff like Zoom and some of these companies that were like very concentrated in the pandemic, they have gone down quite a bit. And so you can get them at a lot better deal than you could like last year. So if we go back into that sort of scenario again, I'm kind of filling the wagon with like some of those stocks again that I think are very important. And honestly, this is just how the economy is going to be from now on in terms of like I thought it was going to be more of a hybrid. Like, the Zooms and stuff would decrease. We go back to work, but like if this keeps happening, we keep getting pummeled. Like, it's just gonna keep accelerating the transition to cloud and all this. So the other category of stocks I've actually been loading up on is related to drought and forest fires and all that in California. And I'll get to that after I cover the COVID part. So on this chart, it's going back up. And here I see we've got second dose administered is 148 million people, or 44.7% of the population, which is not herd immunity. We should have a lot higher than that. So that means there's still like 55% of the population that this illness could rip through. And those are probably, I think you could safely say a lot of those are lower income people too. It just kind of seems to be how this has played out. The first dose administered is 56%. So that's actually a lot better. There's actually 56% of people at least have some antibodies. But I wouldn't expect much more than that. I think most of the people that have started getting the vaccine have already gotten it. Now a lot of the doses are just not getting sent out or anything. There are 101 doses per 100 people, so there's plenty of doses for everybody to have it, but they're not being used. We haven't seen major things yet. California, of course, they're already the highest on restrictions, but they also have an outbreak right now again. And they had just opened up, and now they are already having mask mandates in LA County again. So I just think this is the beginning of things to come. And like I said, I can't predict, but I would be prepared if you've been kind of hammering into the markets really hard. It could be a good time, and I'm not a financial advisor, but and analyze it yourself. Maybe look and see if you think you should. If you're over leveraged, maybe it's a good time to take some risk off the table. If there is that big crash, then you can plow some money back in when it crashes. But it's probably not a good time to be like leveraged. Well, it's never a good time to be leveraged, but it's probably not a good time to be in too deep in risky things, because there's a lot of things up in the air right now that could change. So the next thing is, so another area I'm investing is, another thing they were talking about in the All In podcast I listened to is California, how they have record low snowpack, which reduces how much hydroelectric power they can make, the dams. There's record low moisture content. Everything's just super dry. And there's a perfect scenario, or not perfect, nightmare scenario where you could have lots of fires and blackouts and all this kind of stuff. So I invested in some things like Generac and Cummins and generator companies, looking at investing in some water companies, maybe some air quality, if there's some good air quality kind of stocks, because you got all that smoke. 3M makes all the masks. Like, there's all kinds of different things, but they don't make that much money off the masks. So stuff like Generac, they also do solar. So it's kind of even if there isn't a big fire situation, Generac sells a ton of generators anyway, and they do solar. So they've got a lot of things going for them. There's a lot of industrial purposes for generators as well. Cummins is a big industrial generator company. So the next topic, could there be a black swan situation in crypto? I have had a lot of podcasts on cryptocurrency, and I think Bitcoin is super interesting. Blockchain, I always say I'm just bullish blockchain, the technology. That's like saying in 96, 97, you're bullish the internet. You would have been right. Now, does that mean it was a great time to invest? You could have made a lot of money on the run up to 2000, but almost a lot of things went to zero. And you could have lost a lot of money, and you could have been like, oh, screw this internet thing sucks. And you would have been dead wrong. But if you were talking about cherry picking individual stocks, you would have been right about a lot of them. But you also would have missed out on Google and Amazon and really Apple taking off. And eventually Microsoft again, even though they kind of like declined in the early 2000s. And some other stuff, Qualcomm, a few different things. Crypto is the same way in my opinion. Bitcoin, I want to think it's going to be like one of the biggest parts of it, but who freaking knows? We don't know. Like, it could go to zero. It really could. But I don't think it will, but who knows? Ethereum, I actually think Ethereum has one of the better chances. There's kind of some things hanging in the balance on that too. There's some really interesting projects in crypto that have a lot of value. I look at Polkadot, look at Chainlink, I look at Cardano, a lot of these different things being developed, and I hope they'll succeed. Like, they seem super interesting. NFTs, gaming, metaverse stuff. Some stuff's probably way too early for its time. Maybe some of these like metaverse or NFT things, maybe it's just not the time for it yet. Or decentralized video, who knows? They're already making social medias on crypto. So it could be like the pets.com, to where like it wasn't actually a bad idea. Everybody made fun of it for years, and it took 20 years for pets.com to be recreated in the form of Chewy, essentially. It was way too early. And I mean, it's good to be a first mover, but sometimes you're way too early, and the infrastructure has to be in place. Now, the big thing with crypto is a lot of the infrastructure is in place. It's about the UX, or the user experience, needs to be better. I guess you could say a lot of the infrastructure is not totally in place. You could say regulation is in place, but a lot of them are like, screw regulation anyway. So we'll see. Like, I think it could play a big part, but they think they can go around it. We'll see. It's a big if. But when you had the internet come out, like in the early days of the internet, if you wanted to build a website, it was extremely complicated. If you wanted to, do certain things and run a server and like everything you would have to do, like Mark Cuban was describing, he had an early video streaming company, and he was probably way too early to streaming. He made a lot of money selling it to, I think it was Yahoo or AOL or something like that. He was streaming sports or something like that, and broadcast.com or something like that. He made a lot of money, but ultimately that didn't end up being a big thing for them until years later. Then streaming really took off because it was way too complicated, and it was way ahead of its time. He had the right thought, but the infrastructure wasn't really there. It wasn't super comparable to a TV back then. A TV was just a better experience. So you have to have Netflix won out because it actually had a better user experience than the competitors in traditional TV. But if you actually have a worse experience and it lags, it's breaking up or something like that, like, no one's going to switch over to that. Like, it has to provide some type of value. So crypto just has a lot of stuff. It has a lot of good things and a lot of bad things, and who knows how many of these things succeed. Now, there's two different big assets in crypto right now. You got your blockchains, and you got different blockchains, and then they have tokens affiliated with them. But the common thing of all that is that when you invest in a blockchain token, or you invest in a utility token, or you invest in an NFT token, they go up like almost like the stock market or whatever based off of supply and demand. So I never bought the concept that people are like, oh, people are going to spend Bitcoin like $1. I always thought there had to be some second layer that made it flat and consistent. No one's going to spend a Bitcoin if they think it's going to like be worth a lot more the next day, or that the merchant's not going to want to accept Bitcoin if they think it's going to be worth way less the next day, and they're not going to be able to like. It needs to be consistent. There needs to be something like the U.S. dollar to where it. I mean, yes, there's inflation, but it's not fast enough that we notice it on a day-to-day basis. And it's not like, one day I buy a car and for $20,000 and suddenly that money's worth $40,000 the next day. And so essentially like I lost out on $20,000 I could have had to the shady salesman. Or the opposite, So that's where stable coins come into place. And stable coins are like, right now it's done by companies. And ultimately, I think this is where the governments are going to want to regulate this. Because right now you have either private companies or decentralized autonomous organizations releasing stable coins. And what they're supposed to do is release it like if it's a US dollar based stable coin, it's $1. And it's supposed to track that dollar as tightly as it can. It's not supposed to go up or down and fluctuate. And it seems pretty like nerve-wracking, or it seems just like something's wrong if it does. It should not go up and down much. It shouldn't swing if it's a stable coin. So they are supposed to be backing that by collateralizing it, usually in the form of physical dollars. That's ideally what it would be. But people are greedy. Companies are greedy. Or companies want to make money. And I don't have a problem with a small amount of this. It's like a bank does this. You put money in the bank, and then they're loaning out your dollars. But I don't like this because this is going back to the traditional banking system, which we're trying to get away from with crypto. So what they're doing is instead of just like taking your money, like having in a vault, having dollar for dollar, the equivalent, they are, well, I say they. So they're the main ones. The most popular one is called Tether. This is the one that's really in question right now. And it seems like there's a connection between them and Bitfinex, which was, I think there was some sort of scam exchange that happened with them. And there was a lot of problems. And there's always like some sort of scam that's kind of evolved like every few years in the cryptocurrency space, whether it's Mt. Gox or where a bunch of people lost their crypto. Binance seems like it could be not scam, but a lot of shenanigans going on there. And there's a lot of debate too as to whether crypto, a lot of it is manipulated actually, which is supposed to be not manipulable, by these crazy swing traders and people that can like dump massive amounts or like create multiple wallets and trade between themselves because it's not really checking like who they are. So like if you had a coin that you released onto the market, like you could actually like do a bunch of exchanges, like you could sell a bunch of times and then someone else could buy it between the wallets, and it would make it look like there's all this volume and a momentum. Because a lot of these people that are swing trading are looking for momentum. And you could actually artificially use like algorithms to drive all this like fake momentum that would then cause the like thousands of percent like skyrocket in like a token or something. So Tether, what's coming into question is whether they actually have the assets to back up their stablecoin. And if they don't, because it is like one of the biggest tokens out there, and it's used a lot in these like trading, and gives liquidity in Asia where there's a lot of margin. And there is actually some concern that this could actually domino into the actual economy outside of crypto, because of the magnitude of if this went down. And there's USDC, which is made by a company called Circle, which is going public in a SPAC. That one does not look so sketchy from what I've seen. It looks like they mostly have everything to back up the assets. There's more of a backstory to the people there that work there. And so if I was going to invest in something, I'd probably do USDC. It has some big backers like Coinbase. You really want to see who's backing these companies up. Tether looks like it has a sketchy crew of people backing it. And if you want more information on this, I would look up This Week in Startups with Jason Calacanis. He does a lot on that, on Tether. He has a lot. He's kind of crowdsourced an investigation into Tether and trying to get everyone that listens to him to like dig up stuff. He actually pulls someone on to his podcast and like, confuses their voice or whatever, like makes it really deep. He found them on Twitter, and the guy's Twitter name is Bitfinex, if you want to look him up. And he has quite a bit of knowledge, it seems. Obviously, he was anonymous when he came on the show, but seems to have quite a bit of knowledge as to some of the depth of this, and he thinks that this could be a huge black swan event when this is exposed, like maybe a Theranos or some giant Bernie Madoff kind of scam. They were asked to do an audit, and this guy actually claimed that they finally did an audit, but they had some like guy in the Cayman Islands do it, and they knew when it was going to be. And he claims Bitfinex, the Twitter handle, he claims that Bitcoin actually had a big drop, and it could have been they could have like maybe cashed out a lot and pulled it into their account just to show some collateral while it's being counted. But part of the audit showed that a lot of it is in random commercial papers, and it doesn't seem to be easily traceable where all this commercial paper is, which is like debt that they've like bought up, like corporate debt or something. But no one seems to know whose debt they're holding or something like that they're buying up. And it could be a lot in China, which China has a very sketchy background as to whether you can get your money back out of it, or it's really just unknown. And I think it's very concerning. This is probably the biggest thing that is going to cause the government to step into crypto and be heavy-handed. So I think that if you're a crypto holder, that should make you nervous. And it definitely makes me want to hit the pause button and be a lot more cautious with my crypto investments for now, until I see some evidence that this might play out. I'm not going to sell anything I have right now because I bought low early in the run. Just like the stock market, there's so many things up in the air right now. I might trim some things, and if you're heavily leveraged and you can't afford to lose anything, which I don't know why you'd be in crypto if that was the case, might be a good time to look into how at risk you are. There are alternatives, like I said, USDC. There is, which you can earn interest on that. There's DAI, which you can earn on some accounts. You can earn like 3% on, and you can like loan it out. There's Gemini Dollar, which is supposed to be very transparent. Apparently, it's one of the most transparent coins. It's by the Winklevoss twins in the Gemini exchange. There's different places that have stable coins if for some reason you need to do that. I actually use stable coins as like almost a savings account that I can get a higher interest rate than that 0.5% you get like in Wells Fargo or something like that. You can actually buy stable coins, you can get decent interest rates, or you can loan them out on like Aave or Compound. Those are decentralized loaning dApps, decentralized apps, or you can go on what is it called, BlockFi, and that's a more regulated means of loaning out, or Abra. Abra is another one. That's like a company that you could do that through. So this is really concerning. Here's some key points. This is off of CNBC. It says, why Tether, the world's third biggest cryptocurrency, has got economists worried. It says, Tether is the third biggest cryptocurrency in the world by market value, and it's got some economists, including an official at the Federal Reserve, worried. Boston Fed President Eric Rosengren recently raised the alarm about Tether, calling the cryptocurrency a potential financial stability risk. Some investors believe a loss of confidence in Tether could be crypto's black swan, an unpredictable event that would severely impact the market. And I've heard possibly flow over into the traditional market. And I think that's what's really got people concerned. So, let's see. It says, the issues surrounding Tether hold significant implications for the nascent cryptocurrency world. An economist, hold on. Sorry, my screen is moving. Economists increasingly fear that it could also impact markets beyond digital currencies. Here's what you need to know. Let's see. Yes, like Bitcoin, Tether is a cryptocurrency. Third biggest coin by market cap. Meaning it's a stable coin, meaning it stays at the same amount. You can have stable coins in like a euro or something else. It doesn't have to be pegged to the US dollar. It just has to be pegged to something. You could have a stable coin as representing gold or a synthetic asset. So it says Tether was designed to be pegged to the US dollar. While other cryptocurrencies often fluctuate in value, Tether's price is usually equivalent to $1. This isn't always the case though, and it wobbles in value of Tether. The value of Tether wobbles if spooked investors have made it fluctuate too much in the past. So what do people use this for? Crypto traders often use Tether to buy cryptocurrencies as an alternative to the greenback. So I guess they'll have a bunch of this sitting in their accounts, and they'll just easily transfer between the Tether and the cryptocurrencies they're trading. I don't know why you would use this currency. This essentially provides them with a way to seek safety in a more stable asset during times of sharp volatility in the crypto market. So right now, you have lots of volatility in the market. So what do you think people are doing? They're probably seeking a lot of safety. I think where you would have a problem with this Tether is if you had a run, essentially like a run on the banks, like in the 1929. Like you had, obviously the banks lend out the money, it's being used. If the banks are over lending it and everyone comes in and wants their money right then, they don't have it all to loan out. That's, I think that's why the government started like federally insuring money and stuff like that to make sure that people would always get their money back. But guess what's not insured? Cryptocurrency isn't. So, I mean, if you lose money, you get screwed somehow in the stock market or in your bank or something like that, you have some means to get it back. The big thing with crypto is that, like, yeah, it's cool to be libertarian and like be able to be in control of your money until you lose your money and then you don't have anyone to cry to. So you have to understand that. Why is this controversial? Okay, so some investors and economists are worried Tether's issuer doesn't have enough dollar reserves to justify its dollar peg. That's what I was talking about. In May, Tether broke down the reserves for its stablecoin. The firm revealed that only a fraction of its holdings, 2.9% to be exact, were in cash. So what it's supposed to be pegged to, only 2% is pegged at that. While the vast majority were in commercial paper, a form of unsecured short-term debt. And they don't know where that comes from. It's not like it's coming from Microsoft, who has like an A plus, credit rating. Like, who's loaning all, or whose debt is Tether holding? Or technically, what they were saying could be concerning is that they were dipping into the Tether reserves to help out Bitfinex when they were in trouble. And if that was the case, I mean, technically their commercial paper, if that's all we know it is commercial paper, some of it could be their own company. So they could have taken on a lot of debt from their other company. What if they had all these other little tentacle companies and they just had a bunch of their own corporate paper or their own debt paper? That would be not too great. Technically, yes, maybe they have all these assets. But if that means all these other things would collapse and then implode on them. And this is all speculative, but it is concerning. That would place Tether in the top 10 biggest holders of commercial paper in the world. Let that sit in. Holding the top 10 in the world of commercial debt, according to JP Morgan. Tether has been compared to traditional money market funds, but without any regulation. Imagine if you had a whole money market fund go down. It'd be pretty catastrophic. It would clean people out, and this is spread out throughout the world. People in all countries are using Tether. With more than 60 billion worth of tokens in circulation, Tether has more deposits than that of many U.S. banks. I think that's pretty significant. There have long been concerns about whether Tether is being used to manipulate Bitcoin prices, with one study claiming the token was used to prop up Bitcoin during key price declines in its monster 2017 rally. There's even been suspicion that Tether could be front-running bull runs in some of the cryptocurrency. Like, they could start causing a chain reaction because of the amount of volume they have. And literally they could trigger something and then make money off of that. So it looks like they're being investigated. Earlier this year, the New York Attorney's General Office reached a settlement with Tether and Bitfinex, an affiliated digital currency exchange. The state's top law enforcement official had accused the firms of moving hundreds of millions of dollars to cover up $850 million of losses. Tether and Bitfinex agreed to pay $18.5 million in the settlement and were barred from operating in New York State. So I won't read from that anymore, but I think you guys get it. Like, this could be a big deal, and it could affect the stock market, and it could affect your crypto. It could definitely present a good buying opportunity because, crypto's still there. It's still a good asset, in my opinion. But there's going to be a lot of this bullcrap that has to get filtered out in the years to come. And it seems like this is probably, if this is as bad as it could be, it's definitely going to force the government to play a huge part in crypto. And I don't know what that'll look like. And that uncertainty is probably not a great time to be holding a bunch of crypto. There's some that I will just keep holding, just because you never know. This could just blow over and not be a big thing. But I am definitely considering paring back some of my investments. And if it really does blow up, like I think it could, then that could be a great time to buy. You're talking, if this was on the scale that they are hypothesizing it could be, how cheap could you possibly get Bitcoin for? How cheap could you get Ethereum for? Hopefully the scars of that would not be too substantial to recover from. as far as crypto goes. And I really hope it doesn't take down the stock market. Let's see. Let's go to the next subject. This is kind of playing off the same theme. Is Facebook. For a long time, they've been trying to get into the stablecoin business. And they tried to band together with a bunch of companies to do a stablecoin called Libra years ago. It got a lot of pushback, and now they're back at it again with a stablecoin called Diem. Diem. I'm not a big fan of Facebook, and kind of freaks me out to have them that involved in crypto. I really don't want them that involved in crypto, but this is an investing podcast, and probably could be a lot of money to be made off Facebook, So I try to avoid investing in them, but I want you guys to know what's going on, and they make a lot. They print money. Like, that company makes tons of money, even though they're under all these investigations and everything. They make money. Let's see. So this is actually interesting. The Diem seems to be partnering with Polkadot, which is a kind of like a multiverse of chains. The guy that started Polkadot was on the original Ethereum team. There's Vitalik. He's the guy that started Ethereum with the guy that runs. A lot of the people that started Ethereum now run their own blockchains. Then you have Charles Hoskinson or something that started Cardano. Then Gavin Wood, I think, started Polkadot. So you've got three of the biggest blockchains potentials were all spun off of Ethereum. Or two were spun off Ethereum. One guy's still with Ethereum. So Facebook seems to be maybe utilizing Polkadot. Facebook would probably make their own chain, honestly, if they could. They probably don't want to have anything to do with the actual decentralized nature of anything. They want to, I'm sure crypto is an existential threat for them, so they are going to want more of a centralized blockchain. And that's why I think I would steer clear of all this, because it's against the whole ethos of what crypto and blockchain is supposed to be. But they will probably use Polkadot. Polkadot has a testnet called Kusama, and it's a good platform to test out certain things and to run your token and see how well it works and everything like that. So that's probably what they're doing, is they're using it early on, and they're going to go and try to do their own thing. So let's see. There's just a lot of these big tech companies that are getting into crypto. So you got Facebook doing a stablecoin, and that'll probably bring in lots of revenue for them if they're sitting there and investing the excess money they have. Like, they take the money they get from the stablecoin, invest it properly. I mean, they'll probably do a better job of it than Tethers. So they'll probably make a lot of money off of it without going bankrupt. I think Amazon's doing its own sort of blockchain somewhere in Mexico they're trying out. That'll probably involve logistics or something like that, maybe an Amazon coin. There is Jack Dorsey, who owns Twitter. He also owns Square, and Square bought Tidal from Jay-Z, which they are looking to do. I think they're going to be maybe doing stuff with NFTs or NFTs of music or something like that. He has said that he wants to decentralize Twitter onto the blockchain. He's said that he is getting into building hardware, software wallets for Bitcoin. Now, Jack Dorsey doesn't like anything but Bitcoin. He wants to build a decentralized, like a DeFi, decentralized finance kind of platform on top of Bitcoin, whereas most of it's been built off Ethereum or Solana or some of these other chains. Bitcoin hasn't really taken off in terms of like building apps on top of it. There's the Lightning Network, which is like kind of a like I would call it like almost a cash app on top of Bitcoin, but it's like peer-to-peer transfer of Bitcoin. So I don't know like what that is all about really. I know he hates pretty much anything else besides Bitcoin. And he said at the Bitcoin conference in Miami that he wants to dedicate his life to Bitcoin if it wasn't for Square. He's doing a lot of different stuff. He even said something about getting into mining Bitcoin. So Square making big moves in that space. Visa is now taking USDC coin, not Tethers, which is USDT. USDC is Circle, which is that SPAC that's going public, which I bought a little bit of. There's been a few crypto SPACs that have gone public. One is called Bullish. You can look that up yourself, but I'll go into them in a future episode. It does something completely different. There's just too many things to cover. So let's move on from Facebook. Yeah, I had a note to talk about Circle, but they came public in a SPAC. I don't remember what this SPAC is called. They went public for $4.5 billion market cap. All right, let's talk about the economy. It seems like things are slowing down. Seems like we're getting a lot of slowing down in the economy. There's a lot of uncertainty, and unless we get more money pumped back into the economy, I don't know that we're going to see much happening. And I don't think it's good to put more money in the economy. Let me say that. But I think the economy is like hooked on it like crack or heroin or something. Like it's just tweaking out, wanting more juice, and it's not a good thing, in my opinion. Ooh, I don't want to click on the Wall Street Journal because they make you pay. We've got houses at like record highs. We've got there's just a lot going on. There's stuff in China going on. Let's see. Yeah, they're just looking at a lot of stuff to cool down in the economy. It's kind of a waiting game right now. I think you're going to see a big hit in the return to work, or not the return to work, like the travel stocks. I think you've already seen like Carnival Cruises and stuff like that get hit as you've had this resurgence in the Delta variant. I think you're going to really just see you had this just big boom. We opened like one time and like, of course, everybody's like going out like crazy, but I think that's starting to wear off. And you're going to see a return to like the staple tech stuff and the stuff that has traditionally done very well. Maybe work from home. There is this is an interesting new classification of investing, which is fractional asset investing. And there's a company called CASO, which is PACASO, and it's already unicorn status, worth billions of dollars, and it is seeking to capitalize on surging vacation home prices. They are, let me find a description on them. I think CNBC will be okay. So what they do, from what I've read, is they let you fractionally own your vacation home. Say you want to get together with like 6 other people and own a beach house. You could own like a 6 of it or something, and you'd be like locked in for a certain period of time, and then you could just sell out of it if you wanted. Let's see. Okay, so this says, as home prices surge, real estate startup CASO is buying luxury single-family vacation homes and selling them to groups of buyers through a fractional ownership model as part of an LLC. The co-founder and CEO is Austin Allison. He said, "We're simply making better use of the housing stock by modernizing the old practice that's been around for years." It's founded by former Zillow executives, and the startup has received $90 million in total funding and has a $1 billion valuation. So a unicorn is usually at least over $1 billion. I think this is kind of a cool idea. It's letting people like have an asset and own part of it without taking on the whole thing, maybe making it more affordable, and especially maybe it's helping with the congestion. And like, you know, if some rich person like owns a beach house and they're not using it hardly ever, instead of it sitting fallow. I know a lot of these places are like rented out by agencies or something there, but not everyone like, you know, does that. And like some of these beach houses just sit there empty all the time. So as home prices surge, a real estate startup, it's startup by two former Zillow employees saw opportunity. It's Cincinnati based, and they purchase luxury single-family vacation homes, and then they sell them to groups of buyers through a fractional ownership model as part of an LLC. So this is kind of their case for it. They say most second homes sit vacant for 11 months per year. We're simply making better use of the housing stock by modernizing this old practice that's been around for years, which we call co-ownership. So it's not really a new idea, but it's being like made newly efficient by technology. Kind of like, I mean, all the things with Airbnb, bed and breakfast have been a thing, but technology makes it way more profitable and scales it up. So that's where the potential is for this, is taking an old idea, scaling it up. Allison said the company operates differently from a timeshare. Yeah, I was going to compare it to that, which sells the right to use a fixed amount of time in a property. So it sounds like you actually get equity in it, which I don't think you do in a timeshare. The company also offers integrated financing, interior design, property management, and proprietary scheduling technology services. So more ways for them to make money. Imagine if you and a small group of friends decided that you wanted to own a home together. That's what CASO does, except we handle all the details, everything from bill pay and maintenance to design, so that you can enjoy your second home and not have to worry about the headaches. Up to 8 buyers can purchase shares of a single property. Most of the company's homes are split between 5 and 6 buyers, and the Picasso owners can sell their share after 12 months of home ownership. The owners have complete control, and Picasso is effectively a property manager once you purchase your 1/8 or 1/4 interest in the home. So it says vacation home prices surged. Of course, all home prices, unless you live in a trailer park or something like that, have surged, reaching an average cost of $468,000 in seasonal towns, according to a report from Redfin, the online broker of houses. And demand for these houses was primarily being driven by affluent professionals who were able to work remotely. Of course, it's not the working class people that are slaving away in an Amazon center. However, the number of buyers who locked in mortgage rates for vacation homes fell 11.1% year over year in June this year, according to Redfin, signaling a potential end to the surge. So, yeah, they've raised a good amount of money, and this seems interesting. This is kind of in line with other companies that I've